and welcome to the Roundup, covering what's important to accountants and advisors across the month of September. Inside this month, the tax status of non-profit organisations and how to determine how they're treated under the tax system. We'll also look at a new bill before Parliament that changes the foreign resident CGT withholding rules. But first up, Payday Super. Now, in the federal budget, the government announced significant changes to the way super guarantee operates. Treasury has now released the details of Payday Super. Michael, what's changing?
Yes, so this is a pretty significant change, and particularly a number of employers are going to find this a little bit uncomfortable to deal with, at least initially anyway. The government had announced in the budget that they would be changing the way the super guarantee system works, so that we'd be moving from effectively a quarterly system, so you're making those super guarantee contributions on a quarterly basis at the moment. That's going to change to the point where super guarantee contributions are basically paid as salary, wages and other similar earnings are paid to employees. Hence the name Payday Super. Look, I think the thing to just remember right now is this is not legislated. This was a budget announcement. We don't have draft legislation yet. We don't have a bill before Parliament. But what we do have is a fact sheet from Treasury which really fleshes out what this new system might look like. So just remember that. This is not law yet, and it won't be probably for some time yet. This forms part of what I think is a broader consultation period to try and flesh out all these kind of practical issues and concerns so that they can be addressed as legislation is being drafted. These changes are scheduled to commence from the 1st of July 2026, so we're a bit under 2 years out, but I suspect that time period will go quite quickly, particularly for those businesses who are feeling maybe a little bit concerned about how this might impact them and impact on their cash flow. So the move to Payday Super, the big thing is, as I said, moving away from a quarterly system to a Pay Super every time amounts are paid to employees. The government has suggested that there will be some minor exceptions to that. One example of that would be where you have brand new employees starting. There might be some tinkering with the rules just so that there's a little bit of leeway at that initial phase. But aside from that, the idea is that you make a payment to an employee, you are basically making the super guarantee contribution at the same time. Now, what the government is saying is that there will be a 7-day deadline to make sure that the money that represents the super contribution hits the super fund's bank account effectively. So there is some leeway, but it is really not very much. It's 7 calendar days, but the expectation I think is that you pay the amount to the employee, you also make the contribution to super, and those 7 days just gives you that buffer to make sure that it can make its way through, for example, the banking system and end up with the fund. So we're a little way off yet, but that's the move that looks like is coming. The other thing just to be conscious of at the moment is that some small businesses are able to utilise the ATO's Small Business Superannuation Clearinghouse. That will be retired effectively. The government is saying that from 1st of July 2026, when these Payday Super rules become effective, the ATO Small Business Clearinghouse will no longer be available, and those employers who are using that facility at the moment have, I guess, between now and then to come up with an alternative arrangement for making sure that those payments are made into employee super funds on time.
So what happens if the contributions are not made by the 7-day deadline?
Yes, so if the Payday Super deadline is not met, so the money ends up in the super fund more than 7 days after the amount was paid to the employee, then we will move into a super guarantee charge kind of position, a little bit like what we do now, but the government is suggesting there will be some pretty significant changes to the way that the super guarantee charge rules operate. So if an employer fails to meet that 7-day deadline, that will automatically trigger super guarantee charge. It's not reliant on the commissioner coming and finding it. It is something that's automatically triggered. The employer at that point will then be liable for certain things. The super guarantee charge amount will be first of all made up of the shortfall, so the amount of super that should have been paid to the employee's super fund. At the moment, under the current SGC system, when you fail to make super contributions on time, the super shortfall amount is calculated based on salary or wages, which is different to what the ordinary super contribution would have been based on, which is ordinary time earnings. Now, under the proposed new system, we would do away with that distinction. The shortfall amount would simply be calculated based on ordinary time earnings, so it would basically be the same number. There would be a general interest charge applied. So again, like the current system where an interest charge applies when super guarantee payments are not made on time, there would still be an interest charge, and it would be based on the general interest charge rate, and that would basically continue to accrue until the amount is paid. Thirdly, there is an admin uplift amount. Now, at the moment, again, under the current system, there is a regular admin component that continues to accrue until the SGC amount is paid. Under the proposed new system, there would be this administrative uplift amount, which could be up to 60% of the superannuation shortfall amount. Now, the trick here is that the government is suggesting that employers who voluntarily disclose the fact that they haven't made the payment by the deadline basically have the opportunity to have that amount reduced down. Now, how that exactly works, we don't know. I'm not sure exactly what the process will look like at this stage, but the suggestion is that the government wants to reward those employers who basically pick up on the fact that they haven't met their obligations and they take steps to fix it up without the ATO finding out about it first. So there is, I guess, an incentive to identify where there's a problem, make the payments, and it kind of reduce down that admin uplift amount. Now, if there is a super guarantee charge amount that is owed by the employer, so the shortfall amount, the interest, and possibly the admin uplift amount, it seems like there would be a 28-day time period for paying that. So there'd be an assessment, there'd be a time to pay that. If you miss that 28-day deadline, then you're going to continue to accrue general interest charge, this time on the full SGC amount. So not just on the original super guarantee amount that you missed. So you're now accruing interest on a larger amount, and a further penalty can be imposed on top of that, and that can be up to 50% of the full liability amount. So where you don't fix it up, things just continue to get worse until you do. So the government is really trying to, again, make it pretty clear that they treat this area very seriously. The Treasury paper says that not paying super on time for employees is effectively wage theft. It's the same sort of thing. This is money that is really belonging to the employees. They need to have it, and there will be pretty significant penalties as an employer if you fail to get it to them on time. Now, one of the twists that looks like it's coming in this area is around, well, what happens if you do have an SGC liability as an employer? Well, at the moment, you can't claim a deduction for that amount. The proposal is that you will be able to claim a deduction for SGC amounts from 1 July 2026 onwards. So in the same way that the super contribution would have been deductible had you made it on time, the idea is that you would be then able to claim a deduction for the SGC amount. However, that won't apply to any interest or additional penalties that apply if you miss that 28-day time period to basically fix the problem up and pay your SGC amount across to the ATO, who will then pass it on to the employee's super fund. So we could have a mixed position where some part of what you end up paying is deductible and some part is not deductible, depending on how quickly you fix the problem up. So quite a few things that are a bit different to what we're used to at the moment under the current system, not only the timing of when contributions are being made, but also how you calculate, I guess, the liability when you get it wrong, and whether you can claim a deduction for it or not. Remember, this is just a fact sheet that will probably form part of a broader consultation period. We'll keep you up to date as we find out more.
Now, a bill before Parliament contains some key changes to the foreign resident CGT withholding rules. And what are the main things we need to be aware of?
Yeah, so under the foreign resident capital gains withholding system, a non-final withholding obligation is triggered on certain transactions for land and buildings located in Australia, as well as indirect interests in Australian property. When a transaction involves land and buildings in Australia, the vendor is deemed to be a non-resident unless they obtain a clearance certificate from the ATO and provide this to the purchaser before settlement. When the withholding rules are triggered, the purchaser needs to withhold amounts from the purchase price and pay this to the ATO. The amounts withheld are then applied as a credit for the vendor when they lodge their tax return. The Treasury Laws Amendment Bill that was recently introduced to Parliament in September proposes to amend these foreign resident capital gains withholding rules in a couple of significant ways. Firstly, the withholding rate will be increased from 12.5% to 15%. This will have a direct cash flow impact on vendors when the rules are triggered, unless they are able to convince the ATO to vary the withholding rate, which is still an option in appropriate cases. Secondly, At the moment, withholding obligations don't apply to sales of Australian real property, unless the market value of the property is at least $750,000. The bill also proposes removing this threshold so that the withholding obligations will apply to property sales regardless of their market value. There are also no changes to the rules around vendors applying for clearance certificates from the ATO, or vendors making residency declarations when selling shares in a company or units in a trust that holds real property in Australia.
Does the bill have any other amendments that practitioners need to be aware of?
Yeah, so there are some other key features of the bill which will impact how practitioners deal with the tax administration system. Firstly, as announced in the federal budget, the government is planning to extend the amendment period for small and medium businesses from 2 years to 4 years. Small and medium businesses would be able to apply to the Commissioner for an amendment of their income assessments within 4 years of the assessment being issued. However, this only applies to amendments that are initiated by the taxpayer. The Commissioner will still be subject to the 2-year time limit unless there is fraud or evasion or another exception applies. This will hopefully reduce the number of instances when taxpayers need to seek out-of-time objections, which are sometimes subject to the Commissioner's discretion. Secondly, for tax and BAS agents that lodge STP reports for clients, the bill proposes that employers will be allowed to make standing declarations to their agents that cover multiple lodgements for up to 12 months. Currently, the rules require employers to lodge a declaration for each STP lodgement, stating that the information is true and correct, and that the agent is authorised to give the document to the Commissioner. The proposed amendment should reduce the administrative burden for both employers and tax agents and will commence from the day after the bill receives a stamp. Finally, the bill also provides the Commissioner with a discretionary power to retain certain tax refunds and credits for 90 days. This could be relevant in situations where taxpayers haven't provided valid bank account details in an approved form to the ATO. Currently, the ATO has to issue any refunds or credits as soon as possible, which means that the refunds are sometimes paid by cheque.
We get a lot of questions on the Knowledge Shop help desk querying how certain not-for-profits are treated under the tax system. This is particularly organisations like sporting organisations. Michael, I understand that the ATO has released some new material that helps to clarify how to determine the tax status of these organisations. What can you tell us about it?
Yeah, so we're in a space at the moment where there's certainly been a little bit more focus from the ATO on how the tax system applies to non-profit organisations. And look, lots of practitioners would be involved directly or indirectly with some non-profit organisations, which are now subject to some new obligations. And that includes an annual review form that needs to be submitted to the ATO for certain non-profit organisations. I guess in that context, the ATO has been a little bit more active in terms of just engaging with that community and the people who advise those sorts of entities, just in terms of making sure that they are up to date with their obligations and applying the tax system in the correct way. So what we've seen this month is the ATO release a guide specifically aimed at social clubs, and the ATO wanting to clarify the point that most social clubs, even if they are genuine non-profit organisations, won't normally qualify as tax-exempt entities. Now, what we see from time to time is that certainly some confusion in terms of how a non-profit organisation should be dealt with under the tax system. And this ATO guide kind of, picks up on one of the key areas of confusion. We do see people sometimes assuming that just because you're dealing with a non-profit organisation, that it won't have any income tax obligations. And that's not necessarily the case. Just because an organisation is a genuine non-profit organisation doesn't mean it's exempt from income tax. And that's something that we just need to be really careful about, because we have seen a bit over time where that assumption has been made, it's been incorrect. Well, that can have some pretty significant implications for the organisation when it's discovered that it actually has a tax bill that it might need to meet. Now, in order for a non-profit organisation to qualify as a completely tax-exempt entity, it basically needs to fall within one of two categories. Either it is a registered charity and it's endorsed by the ATO as a tax-exempt entity, or it is a non-profit organisation that falls within certain categories and is able to self-assess its position. Now, you can ask the ATO for help with that, you can submit a private ruling, but it is something that you can actually self-assess when you're not a charity. Now, those 8 categories are really important. We see, again, through our help desk, for example, lots of people who have clients who are maybe thinking about setting up a non-profit organisation. There's an assumption sometimes that that will be tax exempt. Really, the starting point is looking at, do you fall within one of those 8 specific categories? Sporting clubs, sporting organisations can sometimes fit within one of those categories. Community service organisations, there are a range of different categories that can potentially apply, but they are quite specific. Not every non-profit organisation will fall within one of those categories. And as the ATO is pointing out, social clubs, that sort of thing, often won't. So won't often qualify as a tax-exempt entity.
So if we're dealing with a non-profit organisation that is not a tax-exempt entity, what are the next steps that we should be looking at?
Well, if you're dealing with a non-profit organisation and you've determined that it doesn't qualify as a tax-exempt entity, there's a pretty good chance you'll have to lodge a tax return for it. Now, there are some exceptions to that, but look, you need to work on the assumption that you might have some tax obligations that need to be met, and you might need to report to the ATO some of those obligations. But before getting too far into that, what we would be doing is next looking at whether there is any chance of applying the mutuality principle. Now, the mutuality principle is effectively, at a very, very high level, the idea that you can't really derive income from yourselves. And so member-based organisations will sometimes qualify for this on the basis that the income that are received from the members of the organisation shouldn't really be recognised for tax purposes. Now, again, I need to say that just because you're dealing with a genuine non-profit organisation doesn't necessarily mean that the mutuality principle will apply, but many member-based organisations will be in with a chance at least of being able to apply that principle. Effectively, what happens when you are applying the mutuality principle is that you don't recognise income that's been received from your own members, but you also don't get to claim a deduction for expenses that relate to deriving that income or those funds from members. Where an organisation is deriving income from members and non-members, that's where things become a little bit more difficult, because we do need to work through the numbers pretty carefully to determine what needs to be recognised as income for tax purposes and which expenses are therefore deductible. Only expenses relating to income that is assessable, that's going to be recognised under the tax system, should really be claimed as a deduction. Now, the ATO has some pretty good guidance around this. There is a very detailed guide on the ATO website around the mutuality principle with a number of worked examples, and it's pretty thorough. And if this is something you haven't looked at in much detail before, it's definitely worth taking a look at it if you're trying to assist an organisation work its way through that calculation process. So if we're not dealing with a tax-exempt entity, we'd certainly be looking next at that mutuality principle, because it might mean that significant amount of funds received by an organisation are not actually taxable. Now, the final thing I just want to point out here is just be very careful about this, because the way the ATO deals with that principle is different for income tax purposes and GST purposes. Feels a little bit odd, but the ATO indicates, and we've seen some reference to this over the years, that just because an organisation might not need to recognise funds received from members for income tax purposes doesn't necessarily mean that you can ignore that from a GST perspective. So you can end up with a position where an organisation is subject to a GST liability on funds received from a member, even though we're not recognising that from an income tax perspective. So just be mindful of that, just be a little bit careful of that. It does feel a little bit odd. I find a little bit hard to get my head around that at times, but just remember those two kind of tax systems work a little bit differently when we're dealing with entities that can apply mutuality.
And that's the roundup for this month. If your firm is not a member of Knowledge Shoppers yet, we'd love to show you what a difference we make to accountants and financial advisors right across the country every single day. Give the team a call or jump onto the website and book in a time to really see what a difference Knowledge Shop can make. We look forward to speaking to you soon.